It's almost 1 p.m. in Sydney and 11 a.m. in Hong Kong. Welcome to Bloomberg Markets Asia. I'm Paul Allen. Here are the top stories. Asian stocks advanced as upbeat US growth data back the case for a soft landing. Inflation in Tokyo gains pace, putting a potential BOJ rate hike this year back on the table. Kamala Harris defends policy backflips in her first TV interview as Democratic nominee, while a Bloomberg poll shows she's sustaining momentum in battleground states. Plus, Mukesh Ambani promises rapid growth in AI and clean energy, calling them the new jewel in the reliance industry's crown. Okay, let's take a look at how markets are faring this Friday in the Asia-Pacific. Avril Hong's in Singapore. Avril.
Yeah, Paul, markets have that Friday feeling. We're seeing them ending the week potentially and the month in a pretty good mood as the gauge of stocks in the region surging about 0.7%. We're seeing today the stocks in China leading the way. Some of the earnings that have been coming in are looking pretty solid, but we also have the idea that, at least the governments of the US and China appear to be talking. So maybe a bit of lift in sentiment in that regard. But of course, the underlying narrative is one of how the U.S. economy getting that GDP revised higher thanks to resilient consumption picture. That is really what stocks in the U.S. overnight were running with, despite there's concern related to the AI, the frothy valuations, and maybe NVIDIA maybe not living up to all those expectations. Some gains in Japan as well today. Also on the data front, we got Tokyo core CPI numbers. They were hotter than expected. But if you take a look at the Japanese currency, it's pretty much where we saw it this time yesterday, although it's firming a little bit from the morning. We're also seeing the yield differentials narrowing between the US and China, certainly, and the offshore yuan sitting well below the 7.09 level. Taking a quick look at US futures as well, as we saw a mixed close overnight on Wall Street. If you can take a look at this board, it'll show you how the NASDAQ futures along with the S&P 500 futures are faring. Of course, it was NVIDIA that really slid about 6% overnight, maybe recouping a bit of those losses when trading reopens again. So let's get more on markets with Polka Mishra, partner at Javelin Wealth Management and Bloomberg MLife Executive Editor Mark Cudmore. So Mark, let's start with you. You have a very bullish case for equities. Do you see any reason to see that derailed in a way?
No, everything is awesome. I can literally not see any obvious major bearish factor out there. The Fed is desperate to ease, given half a chance. I don't think there's really much justification. The economy is doing brilliantly. The consumer is booming. And of course, they should be booming because energy prices are at the bottom of the ranges. Inflation is coming down. Jobs market is still growing, maybe at a slower pace, but it's still growing. So, of course, they're still spending. Earnings are solid. Dollar is softening at the margin. Literally, it's a rare time. Look, I've been over 20 years in markets. It is rare moments when you get every single major input and you go bullish, 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 bullish. The only thing I can kind of think of is that, okay, valuations are a little bit expensive, but they're not more expensive than they've been before. They're not crazy. That doesn't seem like a derailing. Election, yeah, but it's more likely to be bullish. Neither of them care about the fiscal concerns. So what is it out there? People talk about strong jobs print next week. Yields will go higher. Sure, that'll call a short-term hiccup. Yields going higher because the economy is too strong for rate cuts is a positive for stocks. It means it's good for the economy, good for the consumer, good for earnings. Stock markets generally, it's a bullish environment out there.
Ticks all the right boxes. Polka, what do you think? You agree with that? How much further room for upside do you think there is?
I do think there is room for upside. We saw the numbers come last night. They surprised on the upside. GDP growth, as Mark mentioned. Yes, there are concerns around choppiness. Look, we've had a long, solid run up through till now in the year. And there will be investors who will be thinking, okay, I can probably take some money off the table now. Watch out for the volatility that's coming through to the end of the year. I don't see much downside from here. It'll be a bit more range bound. Probably not as optimistic as Mark. But yeah, there's upside there. There's less risk to equities at this point.
Polka, as much as I hate to rain on Mark's parade, let's take a look at some areas of the market that may be, could be a bit sluggish going forward. I give you Exhibit A, big tech. I mean, we do have the Magnificent Seven, after being magnificent, now lagging the broader index. How much momentum do you feel there is in this space? Is it a buy?
So we are still bullish on technology, so I'm in Mark's camp on that. We do feel that there's going to be a bit of normalization in the expectation of technology. So this week was all about NVIDIA, right? And it feels like its relationship with investors is a bit like a child with demanding parents. So you got 99 in math, why did you not get 100? You got 100 in math, but you were second in your swimming trial, so it's never enough. And I think investor expectation is astronomically high, but we have to remember that we are still in the infrastructure development phase of AI, and the application phase is going to be a bit more long drawn, and investors maybe don't have the patience for that, but it's not necessarily bad because it takes a bit of the focus away from tech and allows it to build at a more normal pace, which we expect to happen.
Polka, I want to jump in here. And Paul, I can't believe you rained on my parade. You've opened a battle there. Yes, it's shameful. The Bloomberg Magnificent 7 Tech Index total return year to date, I've just looked it up, is only 33.5%. It is doing terribly. I'd be really upset with a 33.5% gain after 8 months of the year. I know, it's disastrous. But taking your point, Polka, it sounds like you're sympathetic on the bullish view, but you're like saying it's going to be a bit more volatile from here, maybe less effusive than I am in that bullish view. I kind of understand that. Like, it's been a great year. We just talked about even Paul's lagging tech index, which has only returned 33%. Maybe people might want to take some profit out there, and therefore it's going to be a bit more difficult. I see it, but I think that ultimately, I kind of see that as the path. I think it'll be a bit more rocky than the straight line we've seen. Yeah. But I think that people will ultimately be forced into the market again as they go. The market keeps on ultimately climbing the wall of worry. Do you not see that narrative there?
Absolutely, but what that will result in is in a bit more of rotation as well. So we probably see a bit more going into cyclicals. We'll see more coming into emerging markets in Asia now with the rate cuts pretty much priced in for September and maybe another one later in the year. So it will be a risk-on environment. We will see more coming, and whether it is India, whether it is Asia, whether it is emerging markets, those are beneficiaries. We'll see more rotation. Probably we'll also get more money flowing into Japan because US rate cuts are actually doing BOJ's job for BOJ in the path to normalization. So it may not be just a tech rally, it may not be a US rally. So we have been modestly underweight. That's been our contrarian view on US, but we've been overweight on technology. That's worked very well for us. Cyclicals will come through. I think investors are more preemptive now than reactive to what happens in the markets. We'll see interest in the small cap sector. Now, my worry over there is that as we see the rotation into these sectors, we are still in a high interest rate environment, and it will take some time for the interest rate cuts to flow through into the financials of these companies. So what we saw with tech stocks, expectations are sky high. That's exactly what could happen in these small caps or even cyclicals, where markets will expect returns to come through much faster than it does. So come next earnings cycle, once small caps do not give extraordinary returns, remember last time there was actually a rating downwards in the Russell index. So if that doesn't happen, then we'll probably see another bout of volatility in these stocks.
Divergent views between both our speakers in the house today. I love it, a bit of drama. But I wanted to pose to you the MLive question of the day as well. In terms of returns next month, equities versus US investment bonds and treasuries, where do you see the returns? Do you think equities will do better than bonds?
It's a very interesting month to be posing that question. If you look at it, the average 3-year correlation between midterm US government bonds and equities is at this point at its highest since the 90s. So it's much harder to select an asset class right now. Both are fairly priced in at this point. We will see more issuances coming through in September, so that will probably put a bit more pressure on fixed income. So I'm a little bit leaning more towards equities, but equity reaction of the market is a lot more sentimental at this point. Jobs data is a little off, and we'll see another little bout of volatility. But overall, yes, I think it's still more positive for equities than fixed income.
Polka, I've got a question actually about your favourite. I've got to say, by the way, I agree with almost everything Polka said. I know I'm being difficult today, but it's you and Paul I'm disagreeing with. I'm not disagreeing with Polka. She is talking sense. I agree in her view. The bit I'm curious about is you're talking about Japan as being one of your favourite sectors. To me, the Japan story has been very much about the yen depreciation. In fact, if you look at how Japanese stocks have done in dollar terms, they haven't been a great story the last few years. It's been in yen terms they've been a great story. Again, it's just a derivative of the yen depreciation trade. I mean, I'm curious, if you think Japan can be one of the outperformers outperformers again. Does that mean that you think the yen depreciation trade can restart? Or do you think that they can genuinely outperform in even dollar terms from here?
I think they can generally outperform even in dollar terms. So yes, a weaker yen helps, and a much stronger yen and fastly strengthening yen is going to be negative for equity. So take a bit away from that. But the fundamental story is very strong in Japan. Corporate restructuring is in place. We are seeing the results of that. We are seeing investor returns, shareholder returns increasing now. And just to give you a couple of an interesting data points, if you're looking at earnings revisions numbers, so the ACWI average for the last 12 months is around 8%, less than 8%. Whereas for India and Japan, it's been more than 18%. So it's 18 to 20% range. So there's a lot more value to be unlocked in these markets, even though they do look pricey, especially India and Japan a little bit. Currency will remain a concern. You can always put on your hedges, but the fundamental equity story in Japan is quite strong.
All right, Mark, I've got to tell you, don't take it personally. I'm not trying to pick a fight or anything. It's just wherever I see light, I need to bring dark. It's just me. But Polka, I've got one more question before we go that I think we can all agree on. I think the path of least resistance for the US dollar from here is probably weaker. Does that lead you to look around some emerging markets, particularly in Asia?
Yes, absolutely.
Polka, don't give him an easy win. Argue with him.
I agree with everyone.
No fun. Yeah. Sorry to interrupt. Go ahead.
Yeah, sorry. No, we are bullish on emerging markets, and I think dollar weakness is going to allow the emerging markets to continue or proceed with the rate cuts that they've been holding off for a pretty long time now. We've seen, and there's strong growth stories. If you look at Indonesia, if you look at India, there reforms in Malaysia as well. It's all coming to fore. It's been the currency risk that they've all been avoiding. So I think it's definitely a positive for risk assets and emerging markets in particular, Paul.
All right, Polka, we'll leave it there for today. Thank you so much for coming in and sharing your insights with us. Great to have you both, Polka especially, in this case.
I'm surprised I'm getting a thanks at all, but I'll take it. I didn't get one, actually, sorry.
Polka Mishra of Javelin Wealth Management and Bloomberg MLive Executive Editor Mark Cudmore. Paul.
All right, thanks very much, April. Let's get you to some breaking news out of Intel. Intel says it's considering splitting off its foundry and scrapping factory projects as well. It is said to be exploring options with Goldman and Morgan Stanley. So Intel understood to be working with investment bankers to help it navigate what's been a pretty difficult period in its history. These reports, according to people familiar with the matter, discussing a number of scenarios, but understood to include splitting off the foundry business and scrapping those factory projects as well. All right, still more to come on Bloomberg Markets Asia. We're going to preview India's GDP report. Comes out later on Friday. Elara Capital will join us to discuss why they're expecting a sharp slowdown in the second quarter. First, though, US President Kamala Harris vows to prioritize the middle class if she wins the election. The highlights from her first sit-down interview since she became the Democratic presidential nominee. That's up next. This is Bloomberg. US Democratic presidential candidate Kamala Harris has given her first TV interview since her nomination, speaking to CNN. Let's take a listen to some of the highlights.
My agenda includes what we need to do to bring down the price of groceries. For example, dealing with an issue like price gouging. What we need to do to extend the child tax credit to help young families be able to take care of their children in their most formative years. What we need to do to bring down the cost of housing. And I made that clear on the debate stage in 2020, that I would not ban fracking. As vice president, I did not ban fracking. As president, I will not ban fracking. There should be consequence. We have laws that have to be followed and enforced, that address and deal with people who cross our border illegally. And I think it would be to the benefit of the American public to have a member of my cabinet who was a Republican. We have to get a deal done. This war must end. In the meantime, and we must get a deal that is about getting the hostages out. I've met with the families of the American hostages. Let's get the hostages out. Let's get the ceasefire done.
Bloomberg editor Derek Wallbank joins us now with more. So, Derek, Kamala Harris facing, I guess, inevitable accusations that she's flip-flopping here, reversing on some earlier policy positions. How's she explaining all this away?
Well, look, Paul, I think that, this is Kamala Harris's first big chance since she got the Democratic presidential nomination to sit down with a major media outlet where her campaign wasn't necessarily, the one driving the issues. And it went fine. I mean, Dana Bash, the CNN reporter who did this, is a very, very good correspondent. She asked some tough questions, and Harris was ready for them, I think. I don't think you'll see anything that's a major sort of gaffe point out of this. She and Tim Walz addressed that, but also put, forward their views of contrast, where they thought that they were probably in a better position to take the country forward than Donald Trump and J.D. Vance. And look, this was a moment you sort of watch for it. You see, okay, was there anything that was a big trip up that changes the dynamic of the race? No. Okay, on to the next thing.
Okay, no major trip-ups, but, you wonder whether it's going to be enough to just say values haven't changed. They have to, in a way, defend some of these shifts in policy stances on the wall and on fracking. But to your point, how much momentum do you think Kamala has until November?
Well, Avril, I think it's a great question, right? And if you look at, so a lot of these issues have really localized effects, right? So fracking you bring up is a really, I think, smart one to talk about because it's critical in the state of Pennsylvania, right, where there's a lot of natural gas availability. And we just did another poll, a Bloomberg Morning Consult poll, that found Kamala Harris has risen up to now a 4 percentage point lead in the Commonwealth of Pennsylvania, possibly the most critical swing state. And so answers like that are going to be really big for her, as and when both she and Donald Trump are pressed on the idea of Nippon Steel going after U.S. Steel. It's big in Pittsburgh. So a lot of these things maybe have both a national audience as well as a local audience. Now, if I'm looking at that poll overall, we are finding Kamala Harris in a narrow lead across a lot of these swing states, but a lead, a very different position from where Joe Biden was against Donald Trump. And if you look at it, Avril, across all of the swing states, again, very, very narrow leads in some of these places. But if you were to put this across the entire electoral map, and this were to happen on election night, Kamala Harris would win, and with about 2 states in her reserve as an edge, just in case. So a long way to go. A long way to go, but if you're Harris, you probably like where you are coming out of the conventions into this one-on-one with Trump. And of course, now all eyes are going to be going on to that debate that they have together. Of course, the last debate was a pretty consequential one, was it not?
All right, Derek, thank you so much for sharing your insights. I mean, we still have a long way to go, and as we see in U.S. politics, a lot can change very quickly. But thanks for sharing your insights with us. Derek Wallbank, Bloomberg editor. Paul?
All right, let's get to some of the other top geopolitical stories that we're following. Bloomberg has learned that the Netherlands plans to limit ASML's ability to repair and maintain its semiconductor equipment for Chinese customers. Sources say the Dutch government will probably not renew some ASML licenses to service and provide spare parts in China that expire at year-end. Withdrawing maintenance support could render chip-making equipment inoperable as soon as next year. Nippon Steel says the Japanese government needs to impose an anti-dumping tariff on Chinese exports to protect the domestic industry. Nippon says the firm is lobbying the government on this issue alongside other steel makers. It says others, including the US, Europe and South Korea, have already done so, leaving Japan vulnerable if it doesn't follow. We have plenty more ahead. This is Bloomberg. As we mentioned a bit earlier, Intel said to be exploring options to cope with its historic slump. According to Bloomberg sources, the company is working with investment bankers to help navigate the most difficult period in its 56-year history. Bloomberg's Annabelle Drewers is here with the details. Belle, what more do we know?
Well, it really is interesting timing for this Bloomberg scoop to have come out, because you think about the context of where Intel is right now, and we had those earnings early this month, and they were bleak. You know, we saw the worst share decline in about 40 years for the company. They gave a very grim growth forecast. They also made or announced plans to slash 15,000 jobs. So it's really that question now is, how is Intel going to chart its path forward? And that's really what we understand, is that the company is holding talks with its really long-time bankers, so the likes of Goldman Sachs, Morgan Stanley, and it's trying to get advice on where do they go from here, and looking at the different possibilities. And one of those, perhaps the most extreme, seems to be either splitting off or listing its foundry business. And that's really significant because Pat Gelsinger, who took the CEO role back in 2021, has really promised to turn around the company. And part of that is promising to build out the foundry division and start to compete with the likes of TSMC. Of course, that is the most extreme, as I said. So perhaps more likely right now is that they take a less extreme move and maybe hold off on some expansion plans, for instance, instead. That's what we're hearing from sources, at least.
Belle, what do you make of the timing of this reported move?
Well, as we said, it's really around coming very much off the back of those earnings announcements, and really points to the amount of pressure, really, perhaps that Pat Gelsinger is facing here, given that he's staked so much on efforts on this much-needed turnaround. But the various moves and the potential for these to be enacted, well, the timing of those also really relates to the upcoming meeting that we've got. There's a board meeting that's taking place in September. So what sources have told us is that those various options could be presented at that point in time, but no decisions appear to be imminent for now, but certainly something we're going to be tracking very, very closely.
All right, Bloomberg tech reporter Annabelle Drewers, thank you so much for joining us on that. Intel shares, by the way, they're off about 41% on year. Let's talk about something that's going up now. Chinese EV makers performing pretty well in China. After suffering a little bit yesterday, we did see Li Auto trading significantly lower yesterday, but rebounding strongly today, better by 8.8% right now. So shares connected to Chinese vehicle makers, also dealers as well, showing that sound rebound. We've got some commentary here from Allspring Global Investments saying that sell down in China EV makers after the results was excessive. So we're seeing the market recovering now, despite challenging operating environment, downward pressure on selling prices. These EV makers are showing they can pull several levers that they can resort to defend margins and cash burn. So we've got BYD, which actually had a pretty decent set of numbers yesterday, better by 6%. Great Wall Motor better by 8%, and China Meidong Auto Holdings better by 4.2%. Chinese insurers are also among the top gainers that we're seeing today. We've got China Pacific Insurance there better by 6.8%. It's in fact a positive day all round on the mainland. We've got the CSI 300 better by, let's see now, about 1.6% at the moment. Just a little bit more on those insurance stocks for you. Those strong first half profits really boosting investor sentiment here. Results generally strong across all peers, according to Bloomberg Intelligence. All right, we have more in a moment. This is Bloomberg. Welcome back. We've got China markets just heading to lunch. Could be a celebratory lunch too. The CSI 300 having a very good day, better by about 1.7% at the moment. Got very strong volumes as well. Looks like about 60% higher than the average volume for this time of day. Positive earnings related news, as we were just discussing, particularly out of the insurance sector, helping to boost sentiment. We even have Bank of China saying that it's going to be announcing its first interim dividend since listing back in 2006. ASX. Broader context, though, 80% of the way now into China's earnings season. We've got about 60% of the MSCI China stocks missing estimates, but not really mattering today. The CSI 300 better right now by 1.7%. Avril.
Yeah, digging a bit deeper into that, we are about 80% of the way into the MSCI China on reporting. And as you mentioned, we have about 60% of those companies missing on estimates. And it is disappointing relative to estimates, so more misses than hits. But if you take a look at this next page, it should show you that the three best sectors based on aggregate surprise are utilities, communication services, consumer discretionary, but trailing, the ones that are missing are the consumer staples, infotech, as well as materials. So something to keep in mind as we take stock of this earnings season, how we fared so far. But let's take a look at this next page. I mean, even as we talk about the micro side of things, we also want to keep an eye on macro data dropping in Japan today. And we got that Tokyo core CPI print. It was hotter than expected and picked up from the prior month, so justifying another hike from the Bank of Japan. And certainly perhaps clouding the picture a little is some of these other data points that we got, right? Jobless rate ticking higher, and we also saw a miss on industrial production and retail sales, so not quite as clear cut. And if you flip the page and take a look at what we're seeing on dollar yen, it's really interesting to see how even though we got hotter than expected CPI numbers out of Tokyo, which is of course the nationwide indicator, looking at the yen, it's not that much stronger, actually weakening today. It just gives you a sense of how important those Fed expectations are going forward for the pair. You get the sense that the yen might not rally very much more unless we see a further deterioration in the US economy. Now, staying with Japan, the nation's support for the natural gas industry has fueled the rapid expansion of the $250 billion LNG market over the last half century. The nation has few gas reserves of its own, but has made itself indispensable at every link in the supply chain. And our senior energy reporter, Steven Stepczynski, has more on today's Big Take. So can you explain to us how key Japan has been to the LNG industry?
Really, the LNG industry wouldn't be here today if it weren't for Japan. I've spoken to people from Brunei to Australia to the United States, and they all gave me the same kind of message, that it was Japanese support from the very beginning that got these giant liquefied natural gas export facilities off the ground. They cost tens of billions of dollars, and they need buyers. The Japanese were the first there in Qatar, in Australia, in Malaysia, Indonesia, even Japan, and even the United States right after the Fukushima disaster in 2011. They were there when the shale boom was happening. So not only are they buying the LNG, but they're also financing it with their banks. The Japanese public finance, or JBIC, is the largest public financer of LNG in the world. Japanese commercial banks are also the largest lenders in that space. On top of that, you also have technology companies. Chiyoda and others have built the most LNG plants anywhere in the world. The Japanese kind of spearheaded the invention of the modern LNG vessel, and they own the most LNG vessels on Earth, and they're also the biggest supplier of natural gas-fired turbines. So if you want to build a natural gas power plant, you're likely going to be buying from a Japanese company. So across the entire supply chain, Japan plays a very key role.
Dominant players. Is it possible to quantify the extent in which they play this role on the global supply chain?
Yeah, so for this Big Take story that we have on the Bloomberg Terminal website, we had an exclusive analysis that showed that in the previous fiscal year, Japanese companies made $14 billion from gas-related businesses. To put that into context, Japan's top consumer electronic companies, I'm talking Sony, Nintendo, made about that much as well in profit. So it just shows how large Japan is in that space, and it's big business for them. Even though they're not producing the gas themselves, they're invested in projects that produce the gas. They're facilitating the trade of the gas, and then when it gets to ports in places like Thailand or Mexico, they're also being burned in facilities that were built by Japanese or have parts from Japanese companies.
So, Stephen, what does Japan's support of gas mean for global climate goals?
So that's a difficult question, right? There have been environmentalists that have come out and said that Japan supporting the development of natural gas markets from Southeast Asia, where they're selling their technology and services, risks them latching onto gas and using gas for decades after these facilities are built, instead of quickly shifting to renewable energy. Now, Japan and others within the LNG industry argue that gas is a bridge fuel. It's a way for countries to reduce their dependence on coal, which is dirtier, and shift to gas, which emits about half the amount of CO2 when combusted at a power plant. But there have been new analysis that shows that perhaps gas isn't as clean as initially thought. Methane emissions are a large problem in the natural gas supply chain and makes the immediate impact, climate impact, a little bit harsher than what was initially thought. So altogether, there is this argument that perhaps Japan's gas empire does risk getting the world using more fossil fuels for longer and potentially not hitting ambitious climate goals by the middle of the century.
Well, of course, Japan used to generate a lot of energy from nuclear power. Is what we're seeing in the gas market perhaps a reflection of nervousness following the Fukushima nuclear disaster? And could it be perhaps that it's time for Japan to explore these options again in terms of nuclear energy?
Yeah, I mean, certainly Japan's strategy to expand gas markets abroad is one because they're not sure where their natural gas demand will go. After the Fukushima disaster, they had 54 nuclear power plants that were shut, nuclear reactors that were shut immediately afterwards. They've only restarted a little bit more than 10 of those. So, a third of their fleet, operable fleet, remains offline. Others have been decommissioned. So, depending on how many reactors they restart, they might not need this gas, so they can on-sell it to other markets in Southeast Asia and other places. But certainly, gas poses a few risks for Japan as well economically. It's expensive, right? The nuclear power plants that are idled in Japan have been built. They're ready to go as long as they reach and complete their safety upgrades that were put in place after the Fukushima disaster. They can restart and begin producing electricity and at a much cheaper rate. The problem is there have been many hurdles. There have been local hurdles. The regulatory hurdles are still quite high. You have to do a lot of upgrades, and the manpower within Japan's nuclear regulator is also limited, so they're not able to check all these plants and get them online fast enough. But certainly that is something that the Japanese government and Japanese companies are acutely aware of, that their dependence on gas and this expensive fuel does mean that nuclear poses a really large benefit if they can get these facilities back online.
It's a bit of an energy conundrum. Stephen, great to get you in, sharing your work from you and the team on this story. Really interesting stuff, fascinating, really. Senior energy reporter Stephen Stepczynski. And of course, I encourage everyone to read more on this story in today's Big Take. Terminal subscribers can read the story at NI Big Take or check it out on Bloomberg.com. Paul?
All right, billionaire Mukesh Ambani has doubled down on Reliance's AI ambitions in his shareholders' address on Thursday. Details on his plans for the company up next. This is Bloomberg.
We have built an AI-native digital infrastructure for all Reliance businesses. This ongoing tech-driven transformation of Reliance will propel your company into a new orbit of hyper-growth and multiply its value for years to come.
Reliance Industries chairman Mukesh Ambani there, delivering his annual shareholders address. Let's get more details on Ambani's ambitious plans for Reliance. Conglomerates reporter PR Sanjay joins us now from Mumbai. Sanjay, these addresses have much anticipated, similar in the way that Warren Buffett's annual shareholder addresses often are. What were the key takeaways here?
Oh, so the one key takeaways here, the street was expecting that he would be giving a timeline for the IPO, proposed IPO of his telecom venture and retail venture, but he did not mention about that, and he just told that there are three companies, at least three companies, which have got valuation of 100 billion, and the most highlighting factor was, like he mentioned, about artificial intelligence, AI, at least 80 times. So, which is like a clear-cut, telling how a company, which is from a pure play oil company, is transforming to a consumer-facing company with the help of AI. And he mentioned several times that the company is going to be a deep tech company. So he's not restricting AI to his just his telecom venture, but he's also going to use that AI facility to leverage on healthcare, retail, and even O2C, oil to chemical company. So there's clear-cut transformation, how a pure play oil company is transforming into a consumer base, or rather a digital or deep tech company using AI. And he also mentioned about establishing a gigawatt scale AI ready data center which will compete with Amazon's and Adani Enterprises, etc. So he had clarified his intention, and he also made shareholders happy by giving a bonus share 1:1. And so though Jeffries have trimmed his price target, because there was no mention about capital expenditure for O2C business or even for their telecom venture or retail venture. So net to net, shareholders are very happy because they've got bonus shares, but they are not so happy because they could not get a timeline for the proposed IPOs for telecom venture and retail venture. But the street is like keenly watching how this company is going to leverage the AI capability. And for users, for phone users, they're very happy. From Diwali festival, they will be getting 100 GB of storage to keep their videos, phones, etc., etc. And he also said that at least three companies will be, the valuation is over 100 billion. And he did not mention about more details about the merger with Disney and how it is going to take other shape, how the landscape is going to transform with the using this media. But he did mention about the media is going to be one of the key focus. So his key focus would be the new energy business, the telecom venture, the retail venture, the media business, and the deep tech, how the company is going to transform into a deep tech conglomerate.
So Sanjay, as you say, some of these IPO details were clearly missing, but I also hear about these buzzwords, AI, digital, green. How is this going to help the business as it tries to become a more consumer-facing one?
So Chairman Mukesh Ambani is trying to use that AI as one catalyst which can cut across his business. So he has got business of telecom business, he has got business of retail, he has got O2C, oil to chemical business, and he has got new energy business. So ideally he want to use indigenous technology which is built by the scientists within Reliance. He want to use that AI capabilities which will support, which will cut across all these four verticals, and which can become a business case. Now, what analysts are telling us that AI is just, it's a nomenclature, but it's not actually transforming into a business case. So now people would be waiting how he's going to make a business case out of AI. And he was telling that how, if you're talking, there's a conversation which is recorded in phone, while the conversation is going with the help of AI, he could transcribe the entire conversation. So there was a demonstration held by Akash Ambani and Kiran Thomas, the Reliance executive, how this is going to help. But still, the street is keenly watching how AI will give the money, how it will act as a catalyst, how it will transform a pure play oil company into a deep tech conglomerate.
All right, conglomerates reporter PR Sanjay there in Mumbai. Let's check the markets in India at the open, and much like the rest of the Asia Pacific, heading higher at the moment. Reliance Industries is among the stocks gaining right now. We are awaiting India's second quarter GDP report. Might show a downturn in growth. According to Bloomberg Economics, a boost from taxes that has inflated readings in recent quarters is set to fade. Let's get a preview of the numbers now from Garima Kapoor, Senior Vice President and Economist at Elara Capital. So, Garima, we are expecting to see GDP slow to 6.6% on year. That's below the RBI's estimates. Do you think there's a risk of surprise here, though, in either direction?
The chances of risk of surprise, in my view, are little, largely because the number very well encapsulates what's really happening on all three sectors. Remember, this quarter coincided with election period in India, which led to disruption in spending for the government. It also coincided with an extreme heat wave that led to disruption in services demand. Moreover, elevated prices of commodities have led to compression of margins, and hence the manufacturing GVA has also seen some bit of contraction in this quarter. So net-net basis, I think the headline number is something that should not surprise you on the GDP side. What may surprise you, of course, is a wedge between the GVA and the GDP because of the inflated taxes and the subdued subsidy expenditure number that has been happening for last 2 quarters in general.
Now that the elections are out of the way, though, do you see a pickup in public spending that will be supportive of growth?
Technically, yes. The second, third, and the fourth quarter should see a significant pickup in spending. But remember, when you compare the spending periods, when there are elections versus when there are no elections, our analysis shows that the years when there are general elections, the final spending of the government at least falls short by 5.5% compared to non-election years. So notwithstanding how much the spending picks up here on, both capex and revenue is likely to be an underachievement for sure.
What about the shift in priorities towards perhaps more rural economies or to the state? Do you think that kind of outlines what we can expect in terms of spending?
The central government, in terms of spending priorities, I think, contrary to most people's expectations, the budget did not highlight a significant boost or a freebie or a transfer of income to rural India. They continue to remain focused on fiscal consolidation and on capex trajectory. But what we're seeing is something different on the states and the provincial side, where a significant number of state governments have started to spend on a large number of subsidies and freebies in order to basically win elections and popular support. So I think there's going to be a dichotomy between central and state finances. So what's not being, rather the consolidation at the center level, which really does not bode well for spending on the rural side, actually should bode well when it comes to the state side, because there seems to be a complete dichotomy on that aspect.
Well, we had a reasonably good monsoon in India. I just wonder how strong you think the agricultural sector is looking on the back of that. And are there any parts of the economy, though, that are looking particularly weak and perhaps in need of some support?
Monsoon actually at the headline looks very good. We have a 7% surplus. But when you dig deep and look at the intertemporal and spatial distribution, that's not very encouraging. You have seen part of Northeast India and East India, which is at a deficit of about 17 odd percent. And then you've got central part of India and southern part of India, which are in surplus in excess of 10%. This really does not bode well when you look at agriculture as a whole, because remember, this is a kharif and this is a monsoon-led cultivation in India. So when it comes to actual output and yield, there could be a divergence between the sowing and the outcome in terms of yield. Of course, September remains a crucial month where there can be a catch-up of sorts when it comes to rainfall. But so far, there has been a very skewness in monsoon, which is not very good. This in general should not basically bode very well for agriculture output, but as I mentioned, we should be watching out for the month of September. Another big worry or risk that is emerging in India, and that's becoming very apparent over the last 1 year, is how the balance sheet of the households at the bottom of the pyramid is performing. Remember, significantly weak income growth coupled with high inflation over the last few years has meant that the bottom level consumption has been pretty sluggish compared to that at the top of the pyramid or luxury consumption. On top of it, you're seeing the balance sheets of the household sector at the bottom of the pyramid fairly highly leveraged compared to the historical past. So I think unless there is a prolonged moderation in inflation, a significant uptick in growth, or let's say a huge transfer of income in rural India, the bottom level consumption in India will continue to remain one risky aspect to watch out for.
In terms of risks, what else are you watching out for? Because what are the risks from geopolitics, for example, or energy prices spiking? We have seen the oil price increasing in the past few days.
When it comes to oil prices in India, I think the correlation of India's growth with that of oil prices has reduced over the years, largely because of the increased reliance on clean energy and other sources of energy outside the oil. Moreover, because India's external account remains fairly buoyant because of the services revenue or the revenue that is coming out of non-IT exports, rather the hit to external sector also remains pretty weak when it comes to increased oil prices. So while I would worry that oil prices are rising because of geopolitical risks, the era of India's growth, which was completely or very highly correlated to global energy prices, is probably behind us. So while it seems to be a risk to watch out for, I don't think there is a reason to panic. There are enough buffers both in the external side as well as the government buffers on the government spending and the financial side to basically help us navigate through the crisis of elevated prices for sure.
All right, Garima Kapoor of Elara Capital ahead of those second quarter GDP numbers out of India. I want to get you to some breaking news from Bloomberg. Bloomberg reporting that China is considering allowing refinancing of mortgages to the tune of $5.4 trillion. Now, this would allow mortgage holders and homeowners to renegotiate terms with their current lenders before January. This is when banks typically start to reprice mortgages. This information from people familiar with the matter. I don't want to be identified discussing this information, but homeowners will be allowed to refinance with a different bank as well for the first time since the global financial crisis. So news of potential major refinancing of mortgages in China might do something more to help the property sector there. Plenty more to come. This is Bloomberg. Let's take a look at how markets are tracking around the Asia Pacific, zeroing in particular on some of China's banks. We see Bank of China there in positive territory to the tune of 0.8%. Bank of China announcing its first interim dividend since it listed way back in 2006. And indeed, we are hearing that all of China's major lenders say they are also considering interim dividends. Wonder if this might have any impact on that decision, though. Bloomberg is reporting that China is considering allowing refinancing on mortgages cumulatively worth $5.4 trillion. This could hurt profitability at state-run Chinese banks, although they probably do quite a bit to support the property sector. Take a look at chip stocks as well. We did bring you the news earlier that Intel is reported to be considering splitting off its foundry business and perhaps scrapping factory production. ASML's chip business might also be facing new curbs from the Netherlands in terms of providing equipment to China. All right, that is it from Bloomberg Markets Asia. We've got Horizons Middle East and Africa coming up next. This is Bloomberg.